Hello, ladies and gentlemen, and welcome to our lesson on contingent liabilities. Today, we'll look at contingent liabilities from two aspects, one being a theoretical aspect and the other being a practical example based on a past case that has taken place. We hope that after this lesson, it'll clear up some of your doubts about contingent liabilities and help you to understand how to treat them better moving forward. So first, let's start with identification. Let's split the two words up here and let's see what is contingent. So it's an occurrence that is subject to chance. So that really means that it's something that may or may not take place in the future. If we combine that with a liability, which is a financial obligation to be fulfilled by an entity, we're saying that it's a financial obligation that may or may not take place. And once we see that, we're saying, look, this is something that we might have to pay in the future, but we don't know, and there's not sufficient evidence or recognition criteria to confirm that we will have to make this payment. Okay, so let's talk about recognition a little bit. Recognition is quite simple. It's just the act of including a transaction in our financial statements. And when we look at recognition of a contingent liability, we can see it's something that exists at a reporting date, but may not be recognized because it does not meet all recognition criteria. And this will really become a lot clearer as we get towards the decision tree when we work in our example, because that decision tree is really key or critical to understanding how to deal with something within your management reports or your financial notes or statements. So, if it's possible, if it's present, we can read through these ideas and we can draw up a nice little table and to help us make decisions correctly. I wanted us also just to look at the actual definition of a contingent liability according to IAS. IAS, the reason this IAS 37 was created was in the past, prior to 1994, a lot of companies were trying to smoothen profits from one year to another. So what they would do was they would use some creative accounting or fictive provisions to reduce profits in one period and transfers profits into another period. So IAS came along and they created IAS 37, which helps us to have criteria in order to weigh these provisions and decide whether or not they should be in the financial statements or not. If we're looking at the disclosure of a contingent liability, we must look at a few things here. The whole idea is that when we put a disclosure note in, we give a nice little short description of the contingent liability, who it's due to, why it's arisen, when it arose. We need to include, if possible, what is the financial impact or the estimate of the cost of that liability, an indication of uncertainties relating to the timing. So will there be a court process? How long do we think it'll take? What is it reliant on to happen before it can conclude? And then the possibility of a reimbursement. So possibility from reimbursement is different from an estimate because an estimate's an actual value. The possibility of reimbursement is what possibility we think, how much chance there is that we may have to make this payment. So is it 20%, 50%, 75%, that sort of thing. We want to look at some examples for you so that you could understand a little bit better what a contingent liability is. So these are product warranty claims. It's third-party liability claims, especially in the civil industry where there's buildings involved. Guys might be saying, look, the building fell over onto this person and they died. So that's the kind of a third-party liability claim. CCMA litigations or employee litigations, these are things between employees and employers when there's a dispute and they part ways and there's some unhappiness about how that happened. There may be tax investigations. There may be an obligation of a company or a mining company to rehabilitate the land that it's been working on. And you can see all of these things. It's not confirmed that it will take place in the future. It may take place in the future, and it may take place 5 years from now, 10 years from now. Some may never take place. Some may take place in a very short term, but not be valid, like an employee litigation. Okay. How do we measure a contingent liability? Well, the measurement of a contingent liability, we have to use our best estimate of the expenditure required to settle the present obligation. And that's often left to the judgment of management or independent experts who will look at previous examples, previous case studies, transactions that have happened like this. There may be a history or a trend or something that gives them an idea of what to accrue for. Sometimes it's a little easier. If you have an employee litigation, he's going to CCMA and he's saying he wants a 3-month settlement or a 6-month settlement, and the management of the company will turn around and say, well, we believe CCMA will only give a 3-month settlement, and that would become your value to disclose. So there's really two ways of kind of doing this. There's an expected value, which when you're working with a wide product range, you will use sort of a weighted average value to calculate this. Or there's a most likely outcome, and this is when it's more individualized, like an employee litigation or a environmental rehabilitation of land. So, these are just the two different ways to look at it. But we must always remember to consider the risks and uncertainties of these costs, as well as the future events that may impact them. And we need to then account for those or measure those at a discounted present value. So if we think that we're going to need a lawyer to defend our case, we're going to need to understand how much that lawyer is going to cost us and measure that. Um, excuse me, the same would be if there was court fees or court documents that needed to be filed. All these things need to be taken into consideration and added together to say, what is the total value of our potential liability over here? So we've looked at a few examples, or we've looked at more the theory behind it, and now we're going to go into a little bit more detail with the case study that we found. And we think that the case study will give you a nice idea of how this contingent liability sort of develops over time and how it's accounted for and measured. So what I've done is I've just done a quick little summary of this, and the summary is very simple. It took place in 1992 when Miss Levick spilled hot coffee on her lap. She went to McDonald's at the same time and said to McDonald's, I've had medical expenses and other expenses to the value of $20,000. I'd like you to reimburse me. At that point in time, McDonald's says, look, you've got no case. We don't believe that you will win. We'll offer you $300. So at that point in time, there was nothing really happening nobody really believed it. But Ms. Liebeck thought that she had a case, so she went to a lawyer. And this is for me where it starts to get more real. She went to a lawyer. They filed cases in the court in America. And subsequent to that, McDonald's started to negotiate with her at the time. And in one of those negotiations in early 1994, we saw that a mediator suggested that the parties should settle on $225,000. But in August of 1994, they still went on to conclude the case in court, and Ms. Liebeck was awarded a settlement of $640,000. But then, in December of 1994, after an appeal process, the parties agreed to settle out of court for the value of $600,000. This is interesting. So they went from 640 in August to 600,000, and let's look at our decision tree to understand how to treat this. So let's start off with the 20,000 in 1992. Is there a present obligation of a past event? No, not really. McDonald's doesn't believe that. They believe it might be a possible obligation, so they're saying, we'll pay you 300 Rand. Is the potential of paying that 300 Rand out? Yeah, it exists. It's not completely remote because they may have to pay something. So at that point in time, we'll say, okay, let's just disclose this. So we won't raise a provision in our financial statements. We won't put a value in our notes, but we'll put a disclosure note to say that, look, this elderly lady has come to us and she's claiming 20,000 Rand from us. So that when in our shareholders report, they can understand what's happening in our company. If we go back to 1993, however, when she went to a lawyer and they instituted the claim in the court to the value of 300,000, let's look at our decision tree now. So is there a present obligation as a result of a past event? Well, most likely it's more likely than just being a possible obligation now. It's in the courts. There's a lawyer involved. He's advising her. There's going to be a jury. So there's definitely a present obligation here. Is there a probable outflow? Well, yes, there is, because McDonald's is now also acknowledging and trying to negotiate with Ms. Liebeck to reach to a settlement. So there is a probable outflow here. And is there a reliable estimate? Well, she's saying it's 300,000. as a conservative approach, I would suggest that we provide 300,000 if I was the accountant for the company. So we can see there in 1994, all of a sudden now, we go to, there's a mediator involved, and we go to court and we settle in court for 640,000, and after an appeals process, they settle for 600. So we've gone through the decision tree, we've gone through some examples, and let's just quickly summarize this. In 1992, there'll be no provision in the balance sheet because the probability of settlement is low. Nobody believes that she has a case. Okay. In 1993, however, there will be a provision in the balance sheet for $300,000. And why 93 and not 92? Well, there is an present obligation because the claim relates to a past event and there is a probable outflow of funds. Okay. It can be measured as the claimant has specified in claim the amount that she believes is owed to her, and there is a probable outflow of economic benefits as the court may deem the company responsible, and McDonald's is making offers to the claimant. Okay. Have we considered all the costs in the claim? Unfortunately, we don't have all the details behind it, but what about legal fees that McDonald's would have to pay to the lawyers? That would have to be included in the 300,000. What about the arbitrators' fees, court fees to defend the case, etc.? Even in the 20,000 in 1992, there would still be lawyers' fees because I'm sure that they would have sent to lawyers' letters, they would have sent to, they would have lodged documents to support the case. So, these kinds of costs we should then include in these values, but we don't have them right now. So we'll just look at the values that we do have. Okay. What happens if we have third-party liability insurance for such an event? Okay, so this is interesting because if we believe that we have these kinds of contingent liabilities such as product warranties or rehabilitation, we may decide to take out insurance with an insurance company, and they would obviously pay us. So how would we treat that? Would we say, okay, we have a provision for, or sorry, we have to disclose 20,000 in our disclosure notes, but we have insurance for this that will pay us out 80% of the value. How do we treat that? Well, we don't include it in the same contingent liability disclosure note. We also don't reduce it from the provision into 1993 because we will take that insurance claim and measure that, do a disclosure note as a contingent asset because it's something that we may or may not receive. It will be dependent on the case outcomes, and it won't be deemed confirmed until we've gone through the rounds with the insurance company. So I hope that explains a little bit. So just remember, if we do have an insurance or we will make a sale of assets, they'll become contingent assets or be recognized as sale of assets, but we won't include them in our disclosure notes or our provisions for contingent liabilities. Okay, and how would we account for the liability in subsequent periods until the closure of the case? So what would we do in 1994? Well, it's very simple. In 1994, the case was concluded, so it's no longer contingent because it was confirmed. The judge confirmed the case, gave a settlement value, they went through an appeals process, and at the end of the appeals process, they agreed to settle. So it's no longer contingent on anything. It's confirmed. McDonald's owes Ms. Lebeck money. This is the value that they owe her, and this is when it will be paid. Okay, so let's quickly take a look at an extract from our statement of financial position. So we're just looking at a balance sheet here. We're saying in 1992 we have no provisions for anything. Remember, we're just saying it's a disclosure note. So look at our disclosure note at the bottom of the year. We see in 1992, client McDonald's. We give a little summary here, where she's from, what she wants, that sort of thing. And we'll see that in our notes for our financial statements, at the end of December 1992, we have no closing balance in the top row over there. So we don't account for this contingent liability. However, when we go to 1993 and we confirm the 300,000, almost confirm the 300,000, we're saying they've gone to a lawyer, McDonald's is negotiating, we need to make a provision for this. And if we look at our disclosure notes over here, we have our notes to our financial statements, we have litigations, 300,000, it's in addition to the current financial year, and we can see over here, we have another disclosure note, we're discussing what this is about, but we're not including the 20,000 from last year. Okay, We also now see that we've got a journal entry here. We've got contingent liabilities, S. Liebig, in our statement for financial position, our balance sheet for 300,000 credit, and we've got a litigation expense in our profit and loss for 300,000. That's in 1993. In 1994, however, the case was concluded. So we reverse out our provision for contingent liabilities. Um, we we see that in 1994 in our disclosure notes, we also have no value there for contingent liabilities. Why? Again, because they have now concluded the case, they've concluded the value and confirmed that they will pay it. We now move that 300,000 now goes back into your income statement when you reverse out your provision from the previous year, and we raise a payable provision for S. Liebig for 600,000, which is what they agreed to at the end of the year. I hope that this has cleared up some of your confusion, that you understand our lesson. And please, if you have any questions, feel free to ask us. Thank you.